welcome to the ION Influencers Fireside Chat, where we speak to the sharpest minds from the world of capital markets. I'm your host, Giovanni Modeo, and today with us, we have Jeremy Samuel, who is the founder and managing director of Anacacia Capital. And the topic of today will be Australian mid-market private equity landscape and where are the opportunities to be found. So thank you for being with us, Jeremy.
Thanks so much, Giovanni, for being here.
Perfect. Maybe let's start with an introduction and the background by yourself and Anacacia, and then we'll go into the landscape of Australian private equity specializing in mid-market.
Yeah, absolutely. So look, we started Anacacia back in 2007, so now 15, 16 years ago, really with a focus on investing in established, profitable, here today, here tomorrow, leading small, medium-sized companies. So most of the businesses we would invest in would have revenues somewhere between 20 and the largest, maybe $400 or $500 million a year. And they're profitable, typically $3, $4, $5 million profits up to sort of $50 million or so of profit. And one of their common themes is really around succession, and they're often family businesses that are dealing with wanting to, I guess, look towards retiring, but not yet ready to sell out 100%. So an opportunity for Anacacia to come in, invest in those businesses, take a stake alongside the founders and help grow them. So we've now had four of our investment directors been working together now for more than a decade, together at Anacacia, and before that in some other capacities, really focused on that lower mid-market segment, which we think is a really exciting part of the market. In addition to that, we've also got a listed equity capability, so also in the small, medium-sized part of the business that we can maybe touch upon later. But yeah, that's the quick snapshot of Anacacia and where it sits within the market.
Perfect. So you started a few years ago. How was the private equity landscape then? How many players were there operating in the space where you're operating? And how did it evolve over the years?
Yeah, look, that's a great question, Giovanni. So, I mean, if you go back sort of 15, 20 years ago in Australia, like in other developed markets like the US and Europe, most private equity firms were owned by the banks, the commercial banks, the investment banks. And over the last 20 years or so, they're now almost all owned by employees. Investors want that. They want to know that the people that are investing, have significant part of their own personal wealth invested alongside them, etc. So there's been quite a change over the last 20 years in terms of the landscape. The other thing that I'd say is there's been quite a segmentation in the Australian market. So you've got at the large end of the buyout market, you've got quite a number of large global players that are operating here. Firms like KKR and Carlyle and CVC and Bain. It's Sydney and Melbourne, beautiful cities, a great part of the world to live in. And there's a lot of those large players. There's also a number of the more traditional mid-market players in Australia that have got larger and are now on that sort of $1 billion plus sort of fund management side. At the other end of the market, there's been quite a lot of growth in the early stage sort of venture side. That's obviously been a bit more troubled for that end of the market over the last sort of 12 months or so. And there's not that many people in that mid-market. I mean, Anacacia obviously operates in that lower mid-market. There are some other firms. But what we find is that if you look at on the flip side, so that's the supply of capital, quite a lot of large buyout firms, quite a lot of early stage, not that many in the sort of lower mid-market. If you look at the size of businesses, Australia is very much a small business economy. So, there are 2.5 million small businesses in Australia. Now, many of those are very small, only 1 or 2 employees or sole traders or less than 20 employees. And they're typically, too small for a firm like Anacacia to invest in, but there's a role for venture and banks and other markets. At the large end of the market, there's 3,000 or 4,000 or 5,000 companies. There's a very developed stock exchange here. The Australian Stock Exchange is, very well regarded globally. And there are a number of sort of multinationals that operate in here. There are about 50,000 mid-market sort of businesses, which is really that segment that Anacacia sort of focuses in on. And there's only a small handful of private equity firms that, I guess, target those sort of family businesses in that sector. We're obviously biased, but we think that's a great place to be. It's quite an inefficient end of the market, and there's an opportunity really to add value to companies and really assist them deal with that succession and sort of growth.
And how many players are there in the market, just to inform the audience, between yourself and the KKR of the world? So in other words, what would be your exit opportunity? So when you grow the company that are now in the region of 200 million to 300 to 400 million, would they be ready for the KKR of this world for Australia, or is there something in between?
Yeah, it's a good question. There is a bit of what I guess they call a secondary market that's been developing in Australia, where firms like Anacacia, as we sort of invest in family businesses, can help expand those companies. And if they want to stay with a financial investor rather than going through an IPO or a strategic investor, then there is an increasing number of those large sort of buyout firms. So the level of secondaries is not as great as you might see in a market like the UK, where it's a very large part of sort of exit transactions, but it is an increasingly important part. So for a firm like Anacacia, most of our exits would be to strategic or trade buyers, but we've had a significant minority of sales that have been to financial investors, both through the public markets, through IPOs, but also to other private equity firms. And I think that's going to be an increasing trend, that we're going to see those sort of secondary type transactions, because there are some really great businesses that are growing and expanding, and financial investors are looking for an exit. And at various stages, as you know, Giovanni, sometimes the IPO market's wide open, as it's been for many years, but the last 12 months, the IPO market's been quite quiet in Australia, like in other markets around the world. And that means for the larger buyout end as well, it's a bit harder for them to sort of exit. For us, that's less of an issue because we don't rely much on the IPO market. But in fact, there was a headline. The major newspaper in Australia, financial newspaper, is called the Australian Financial Review, and you may have seen last week they had a headline saying "Worst IPO market in 30 years." And then when you read the detail of the article, it said we've only been collecting data for 30 years, and the IPO market has never been worse, which is an interesting dilemma, right? Because the economy is actually very strong. Australia's managed to avoid going into recession. Yes, interest rates are a bit higher, inflation's a bit higher, but unemployment's still relatively low. And but Australia's not been immune from the sort of impacts around the global economy. So that IPO market has really softened, and that means from an Anacacia perspective, I guess the companies we're talking to that otherwise may have thought about doing an IPO that were at the smaller end can then look at someone like Anacacia and say, well, maybe actually here's our opportunity to take capital from a firm like Anacacia, do somewhat of a sell down and partner with somebody that can help us grow, particularly when they want to still hold on to some of that equity and share in that future growth.
We had some speakers earlier on or later last year saying that in this time, maybe private equity firms will need to hold on to their portfolio companies for longer. We were talking more to the high end of the spectrum. Do you see that risk here in Australia as well? And what do you need to do to get the value in a longer period of time?
Look, I think inevitably during this sort of environment across all sectors of the market, you find people hold on to assets a little bit longer. Maybe it's because the owners of the assets are a bit more optimistic than the potential sort of buyers. So it's definitely in Australia at the moment, it's a better environment for buying businesses than selling. There are I guess, we talked before about the IPO market, but also a number of trade buyers are a bit more nervous about sort of acquiring. For those that are listed, it's harder for them to raise capital in order to make those acquisitions. But still the demand, if you like, for sort of investing in businesses is still there in terms of that succession side. So I suspect we will see people holding on to assets for longer, particularly profitable, well-managed sort of companies. I mean, from an Anacacia perspective, we're always very happy to do that if a business is returning a lot of dividends, and indeed, in our a number of funds, one of the things I think investors like about Anacacia is that our J curve, if you like, of investing is much less pronounced than other firms because we're investing without a lot of debt into our companies. So you're actually returning dividends. And we find we get a lot of positive feedback from our investors around that. So I think as long as you're still able to return capital back to investors through dividends and the like, I think investors are very patient and very comfortable sort of with that. I think for some other firms, from what I hear, they're finding it a bit more challenging because maybe their businesses either aren't profitable, say at the venture end, and it's harder for them to exit, or maybe at the large buyout end, they've got a lot of debt. The cost of that debt's obviously gone up. So the capacity to pay dividends along the way has become tighter, and the banks are kind of constraining them. In that lower mid-market, during the current environment, I think well-managed private equity firms should be able to both help their businesses grow, but also return dividends from their best performing companies back to investors. and just ensure that they wait for the optimal time to exit. I mean, that's one of the great advantages, right, of a relatively illiquid private equity fund with a 10-year life, which is the traditional model, is that when times are somewhat depressed, if you haven't got a natural buyer of that business, you're not forced to sell. You can actually hold on for sort of longer. Now you obviously can't do that forever, but you can sort of time that sort of appropriately. So I think we're kind of seeing the best quality managers sort of holding on to their assets appropriately and looking for that appropriate sort of sale.
And is the dividends the best structure that you find, or are there any other alternatives if you have to hold for longer?
Yeah, I mean, I think the two major ways to return capital to investors, if they're shareholders, right, is either through dividends or through an exit. But sometimes you can accelerate those dividends. So it could be through profits, but also what we're seeing is that if businesses have very low leverage and they're very profitable, there's an opportunity perhaps to do a dividend recap, and that helps you to sort of return more capital. There's obviously been a trend towards continuation funds and other sort of secondary assets where you can give investors an opportunity to continue or potentially step off. And I think the other thing that we're sort of seeing is sometimes sort of a partial sell down and by the private equity firms. So rather than a full exit, maybe bringing on another investor, but not necessarily completely sort of selling. So, if I think about things like our Fund 3, for example, we've now returned more than 50% of the capital without selling any assets. So that's just through sort of dividends along the way. Now that's relatively unusual, I know, compared to other private equity firms. And it's not right for all investors, but for those investors that want to get some liquidity along the way, it's a good way to do that without giving up the upside, which is why you're actually investing in that fund to start with. I guess there has been a move also towards some people raising capital through, I guess, liquid structures where they have like a liquidity for the investors. We have a little bit of a concern around that if the underlying assets are illiquid. That's a mismatch, obviously, between liquid and illiquid. So I think it can work for some of the very large fund-of-fund type products where they've got a lot of exposure across a number of sort of assets, but can be a little bit more challenging for sort of single focus sort of funds. But getting that liquidity to people's, I think it's important. But you just want to make sure you're doing it in a way that looks after the best interests of investors over the long term, and of course protects the founders and management teams that are investing alongside you. You want to make sure that they're also sharing those successes.
And can you remind the audience the size of the fund and the previous funds and who more or less the investors are?
Yeah, absolutely. So our last fund, which we've now just finished the investment period of, was a $300 million, these are all Australian dollars, so $300 million low mid-market buyout fund, our Fund 3. We're now raising Fund 4. Late last year, we did a first close on Fund 4, which was north of 150 million. And this year, we're going to finish that fundraising. We put a hard cap on that fund of 450 million Australian dollars. So that's a bit over about 300 million US, depending on what the exchange rate is. So we're very much staying focused on that lower mid-market where we're able to, I guess, deal with businesses with succession issues, and we're continuing to hold on to, as you know, one of the things that Anacacia is quite well known for is its proprietary deal flow access. We spend a lot of time going directly to business owners. Every business we've ever invested in, we've had exclusivity. Over 15 years, we've had exclusivity before we've spent any money on due diligence. And that's really just to make sure we get to know those businesses really well. They get to know us well. It's an efficient use of the fund's capital. It's an efficient use of everyone's time, the founders, the management team's time, and our own time as well. So we want to stay focused on that small, medium, we call it sort of the SME end of the market, but that sort of lower mid-market size, as we mentioned before, sort of typically businesses with revenue sort of 20 to 500 million, earning somewhere $3 million and up in terms of sort of profitability. So we think it's despite what the headlines sort of say, that it's a terrible time for sort of fundraising, and that for us is exactly the time you actually do want to be out there raising capital. You do want to be out there investing, because there are still so many fabulous sort of businesses there. We've got a database of about 7,000 companies that we've developed over the last 15 years, which we have relationships with. There's a subset of those which are kind of on our high priority sort of target list, if you like, about 10%, which we think are of the right size and scale, dealing with succession issues. And the goal is really to invest in 7 to 12 of those businesses like we have historically. And I think, even going back to, I guess, what we we're chatting about a little bit before and the current environment, it has some parallels with when we first raised our first fund in 2007. It's different times, but it was obviously a very tough economic times through that 2008, 9, 10, 11. What in Australia we refer to as a global financial crisis, known as other crises in other parts of the world, but it was obviously a tougher economic time. And we're seeing a lot of parallels at the moment. And that vintage fund from 2008 to 18, remains Australia's top performing buyout fund across any vintage, any firm. And we're not saying to our investors this next fund is necessarily going to be the same as that, because one never knows, but it does feel like a similar environment where there's pessimism in the market, limited competition, but some really great entrepreneurial sort of businesses out there which are on our pipeline that we're talking to.
So you went from 300 and you are looking to raise 450. If you were to go above that, will it change things for you? Is that a different kind of job?
No, so we're not wanting to go any larger than that. That's why we've said an absolute hard cap of 450 million. And if we didn't raise another cent, that's also fine. We can run the strategy as we are at the moment. We have no aspiration to be $1 billion fund. We don't want to be in that larger buyout end of the market. There's nothing wrong with that end of the market. It's just a different skill set. We like dealing with founder managers at sort of mid-market size of the business, and it's we've always tried to stick to our knitting with there. We may do slightly more investments if the fund's on the larger size, and we may do up to 12 investments. Our last fund had 7 companies in it, but they'll be exactly the same. If we kind of think about the businesses where Anacacia have been successful, they've been exactly that size and scale. So businesses like Appen and Home Appliances and Lom and Rafferty's Garden and Big River and Direct Couriers. These have all been, very similar sized businesses or the same size businesses to what we're focusing on today, those kind of family type companies. We'll be able to sort of back them. And that's what's helped us generate that 25% plus net IRR back to investors before. And it's a similar sort of focus going forward.
And is having one strategy still valuable here in Australia? Or do you think at some point you will have to expand to other strategies?
So we have 3 offerings for our investors. So the private equity offering that we're talking about today, and that strategy is it's the same strategy. You have to obviously adapt a little bit to the changing environment. We spoke a little bit about the fact that it's a better time to be buying right now than selling. So you've got to make sure you're really disciplined with that. In the same way, in the last 2 or 3 years, prices were just incredibly high and debt was really cheap, and so we had the same strategy, but how we executed it was quite different. So we were very careful about not investing capital. So I know, some firms are out there investing a lot of money and raising capital every sort of 12 months or so. We did the opposite, right? We really pulled back and we made very few investments because we just thought that the risk was too high. And by the same token, when times like in 2008, 2009, when the economy was really tight, that's when we made a lot of investments and we thought it was a really good time to be doing it. And it kind of feels like that over the next sort of 12 months or so. I mentioned we've got 2 other strategies as well. So we've found a lot of our investors, some of our investors just want to focus on supporting Anacacia to do private equity, and that's great. But we find some of our investors, particularly the family office sort of side, came to us about a decade ago and said, how about the smaller end of the listed market in Australia? That's been a successful segment of the market for a long time, but there are fewer and fewer players operating there because there's been kind of a push for a bunch of other reasons, I guess, around having very large public managers, low fee base, hugging the index. So we looked at that and we hired a dedicated team. We've got 2 terrific portfolio managers that lead both an Australian focused small cap strategy called the Anacacia Waddle Fund and also a global small cap strategy called the Anacacia Global Fund. Shahan's based in New York, comes back to Australia every now and again. He was here last week. He comes back at least a couple of times a year. And Tom, who runs the Australian part of that strategy, is based here in our offices in Sydney. And so what we find as well is, I mentioned before, all of our deals have been exclusive. And, all our founders are very sophisticated, and the advisors they've got are sophisticated. So we want to make sure we're backing the very best businesses. So we're always trying to differentiate. How can we be a bit different? How can we add value to those companies? And one of the ways we can add value to those private companies is hopefully, we've got a great investment team that's been working together for a long time. We've got a business advisory council of senior operators who've got great, deep sort of industry expertise. But we've also got this listed capability that while those funds have done really well by themselves, but it's also quite helpful for our private equity backed companies, because as we're looking at I guess originating opportunities, it's great for the founders to know that we can potentially follow them if the company one day lists. It's good when they're thinking about competitors and we have a team on the ground that's kind of looking at the listed companies and what the public information is and just getting that really quickly and promptly to the team. And similarly on the exit front, whether or not it's I mentioned before, we typically our exits are to trade buyers, but the fact we've got people in the team that are talking to a number of those trade buyers in another capacity also means we've got kind of an ear to the ground. So that's really helpful. But our core private equity strategies focused on that lower mid-market, we don't see that changing anytime soon.
And you have no intention of launching a venture capital or growth strategy or private debt, private credit?
Yeah, we wouldn't go into private debt. I mean, there's been huge growth in private credit. It's clearly very popular. It's been very popular over recent years, and Australia's been no exception. There's been a huge growth in private credit markets. As a equity provider who sometimes borrows money for our portfolio companies, that's a good thing, because it means there's more competition with the banks. There's a lot of these non-bank sort of lenders, but at this stage, our view is that it creates some conflicts that aren't worth trying to. That can be challenging to manage. I know other people have been able to sort of navigate that, but we're very much focused on the equity market, the private equity and the listed equity, and established profitable businesses. There's a lot of really great innovative startups and early stage businesses, but we'll leave that to the experts who like to focus on that side of the market. In the same way we leave the very large leverage buyout end of the market to, there's some terrific, big global firms and indeed some big Australian firms focus on that end of the market. So we're happy to leave those segments to themselves, and we like focusing a bit on those more inefficient areas where maybe others don't like to tread, and we've been fortunate to develop a great reputation, hopefully, and over the last 15 years or 16 years in that lower mid-market.
Perfect. So maybe now let's go into your relationship to your portfolio companies. Do you normally have a hands-on approach, or when you acquire a company, you let them alone for a while and then you intervene when something happens? So how does it work for you?
Yeah, so a couple of things, Giovanni. So firstly, we're only investing in business that we think are really well managed. So we don't think we're either smart enough or risky enough, if you like, to invest in businesses that are turnarounds or that we think are poorly managed. We invest in businesses that fundamentally we think are well managed, good businesses. And if there's a need to help complement the management team, because, for example, maybe the founder has stepped down or completely retired, then we'll try to make that hire during the due diligence phase prior to our investment, and we'll help them. If they need a new CFO or they need support in their management team, we'll help them to hire that into the executive team. Now, sometimes they've got a full management team, and that's terrific. That's obviously great when you don't need to make any changes as well. We'll then typically put 2 or 3 of the Anacacia team on the board as active non-executive directors. So we often say we're an active but not an activist investor, right? So we're kind of there then to support the founders, support the management team. We have formal board meetings, monthly, as you'd expect in other sort of private equity-backed sort of firms as well. But we're also talking to the companies, typically sort of week to week, helping where we can. So that could be, anything from helping with strategies, helping with M&A, helping with just peer-to-peer professional learning. So one of the things, for example, that we really ramped up during that COVID period and have continued to do is to connect all the CEOs in our portfolio companies, but then also all of the CFOs, the chief financial officers, also all the chief people capital, or sometimes it's called a different function within the different businesses. And actually each of those disciplines, we have to have kind of a peer-to-peer learning session. Every few weeks they get together, normally on video call like we're doing here, but if they're in the same town together, then actually in person, and just talk about issues of common interest. And the broader Anacacia team helps to facilitate that. We also do things like, we call it our, like we're having this fireside chat at the moment, we talk about our CEO fireside chats as well, where we give an opportunity about every few weeks. Typically it ends up being about once a month. One of the portfolio companies will sort of host a video call, and sometimes in person, with the broader Anacacia team and the other CEOs in our portfolio company. And that includes what we call our business advisory council, who are really senior business leaders who invest in Anacacia funds or invest alongside us. They're not full-time in our business, but they sometimes sit on the boards of our portfolio companies. And they often have really great ideas. So a CEO might say, hey, and we'd say to that CEO in that session, please pick one or two issues you're really grappling with. Like outside your board meeting, it might be, I'm grappling with, I'm trying to really enter a new market, and here's what I've tried to do. It's been of limited success. Anyone got any other thoughts? Or we're really struggling to hire at the moment. Has anyone got some more lateral ideas how we can do this? Or we're trying to get people, back into the office post COVID, or we're trying to build a new product extension, or we've made this acquisition and we're worried about the cultural integration. And there's terrific conversation that happens. And what we find is that for many family businesses we invest in, many private companies, it's quite a lonely existence running their business. They've done a phenomenal job running their business to date, but they're now ready to say, you know what, I need some external, not just capital, maybe to diversify the family wealth, but also some intellectual capital, if you like, and some external stimulation, because while the team's great, it would be good to get some other people on the board and even outside the board, being part of that Anacacia family, if you like, really kind of to help support them. So that's a really huge part of what we try to do, is kind of, originate well, pay fair prices for businesses with fair structures, but then add value to those companies in a way that, works for the founders and the management team and works well for our investors.
Perfect. So we're approaching the end of the discussion. A few very fast questions with fast answers as well. Interest rates going up or down, and then how is your portfolio going to be affected by that in either way?
Do you know what? We plan for both, because we're not experts. Sometimes, one wonders if the Reserve Bank themselves know where they're sort of going. I mean, what people would say at the moment is we're close to the higher end of the current interest rate sort of cycle. I'm not sure. I mean, we're kind of always a bit glass half empty. So we're kind of always thinking, well, if interest rates did go up even further, how would we respond to that? So and if it doesn't and it goes lower, terrific. Obviously, that's a good thing. So how we're responding, we're making sure we're not putting a lot of debt into our businesses. We're very conservative with sort of capital structure, and we're ensuring that we're kind of thinking about what's the impact on that business, not just its capital structure, but also its customers, its suppliers, and ensuring that we've got sort of, an efficient use of that balance sheet, and that the flow-on effects, why is it interest rates go up? They go up often because inflation is kind of increasing. So then also just making sure we're trying to invest in businesses with good pricing power that are actually able to cope with a higher inflation environment. If inflation ends up dropping, like a lot of the forecasters are saying, and interest rates drop, well, that's great. That's a good place to be as well.
So, and you mentioned the capital structure. So how often do you look at the capital structure of your portfolio companies?
We're looking at them constantly. I mean, I think it's obviously really important up front, and that's when you're sort of setting the sort of scene. But you've got to reassess it every now and again and just make sure that you're operating efficiently. Should you have, more equity, more debt, less equity, less debt. So,
is that weekly? Is it monthly?
At a minimum, you're doing it monthly at a board meeting, sort of from a board meeting sort of perspective, and you're doing it in a big way when you're doing your sort of annual budgets, etc. But if you're having to worry about it more on a daily or weekly basis, it's normally because something's going wrong and you're having to really watch cash flow. So hopefully you're not in that position and you're able to think strategically out to what's the right business strategy for the company, and then have in place the right capital structure. So only as that business strategy changes, a little bit to the left, a little bit to the right, then you might slightly adjust that capital structure.
But do you always look at the peers and say, okay, this listed company just issued the bond. Does it raise a bell for you? Or it doesn't affect you?
We try to run our own race somewhat. We're a little bit, you have to be, I guess, conscious of what's happening with competitors, but if competitors have got different capital structures, that doesn't really influence us in a big way. We're just kind of thinking about really, because our businesses, they're profitable, they don't need capital to sort of fund losses or working capital. So as long as they've got, sufficient capital to follow that strategy, then, we're a bit indifferent to what the competitors are doing. You're curious as to what they're doing, but in our end of the market, we're not trying to, it's one of the benefits, right, of not being listed companies. We're not trying to sort of focus on shorter term targets. We're really focused on building that longer term value and having the right capital structure for the longer term.
And would you have the same approach if the cost of debt was cheap?
Yeah, look, I mean, I think, as the interest rates change, then you've got to constantly reassess your cost of capital and what's the optimal way to do that. We have, like, when interest rates are a bit lower, there are a couple of our businesses which had a lot of excess cash, and we actually borrowed a bit of money, did a dividend recap, returned money back to investors. It made sense to have some debt on the balance sheet. They were very mature, strong cash flow businesses. As interest rates go up, that's obviously less of a desire to do that. Fortunately for us, we don't have any of our businesses which are sort of struggling with a lot of bank debt, and so if anything, maybe we were too conservative during that low interest rate environment, and maybe we could have taken on some more debt, but we'd rather do that and sleep soundly and have our management team to kind of focus on that strategy rather than over gearing the businesses.
And would that be your decision? Would that be initiated by the CFO?
It's definitely a decision where everybody's voices are important. So you want to make sure that the management team are very comfortable, both the other shareholders and the management team, with the capital structure you've got in place. The CFO's got to be right across it. Clearly, that's what they're dealing with sort of day to day. It depends on each business, but usually Anacacia is the largest shareholder, and where hopefully we bring some expertise in capital structure. So normally the other shareholders and the management team are looking strategically for Anacacia to provide assistance on what's that optimal sort of capital structure. But I can never remember a case, in fact, there's never been a case, I think, in Anacacia's history where we've had a different view from the management team around that capital structure. So, normally everyone puts their minds together, you come to a pretty similar view, and you focus on relative strengths within the board structure and the shareholder structure. So that's something where we're normally able to help the companies when they're kind of thinking about that. And we've obviously got relationships with a lot of banks and a lot of non-bank sort of private credit lenders. So when we're looking at refinancing, Anacacia can normally roll up their sleeves and assist.
Perfect. Jeremy, thank you so much, and thanks everyone for listening.
Thanks, Giovanni. Great to catch up, and thanks for including us in the series.